Here is something that's completely counterintuitive. It's somewhat of a contradiction even. On the one hand, we should be following trends, right? The trend is your friend. Bitcoin goes in cycles. Stock markets go in cycles. When times are good, we should be riding the wave. We should potentially even buy very high risky meme coins, take maximum advantage of bullish times. So that's the one narrative. But then the other narrative is that we should be selling at peak hype, that we should be buying when there is blood in the streets, that we should be contrarian, right? We should do the opposite of what the masses are doing because we don't want to be part of the masses. We want to be part of the minority that tends to win. Now that seems like an obvious contradiction, right? Should we be following the trends? Should we be jumping on the trends? Or should we do the opposite what everybody is doing and buy when all the other people are selling and sell when all the other people are buying? What's actually the right approach here? What actually makes sense? I believe the answer to this, the resolution to this, is time horizon. If you have a medium-term time horizon, as in several weeks to several months, then following the trend makes a lot of sense. And the data supports this. So when you look, for example, at a trend following strategy like the moving averages, right? You can have your price chart, and you can plot a moving average on that price chart. And say you buy whenever the price is above the moving average, you sell whenever the price is below the moving average. You're following the trends. That is a bit of a laggy indicator, but still, you're definitely following the trends. You're buying in when we are already somewhat high. You're selling when we started to already decline. You're following the trend. When you backtest a strategy like this, which I've done several times for Bitcoin, also for other assets, also for different moving average durations, I've done all kinds of permutations of that backtest. When you do this, you find out that especially for crypto, following trends tends to be a very profitable strategy. So for Bitcoin, for example, the best moving average is the 120-day simple moving average across different time windows. So let's say you take the first 4 years of Bitcoin's existence versus the last 4 years, etc. The 120-day seems to be working relatively well. But again, this is following the trend. This is not doing the opposite. It's not buying when there's blood on the streets. It's rather selling whenever we tend to go down, and vice versa, buying when we tend to go up. So following trends on that time scale, right, on several weeks, tends to work very, very well for crypto. However, it does make sense to be contrarian when your time horizon is longer. So when you want to hold for, say, 2 or 3 years. In that case, it very much does make sense to buy when there is blood on the street. So for example, to buy whenever the price is below the realized price. So feel free to simply just search this, right? Search in Google Bitcoin realized price. You will see the aggregate cost basis of the entire market. You know at what price on average did Bitcoin move. And you know that whenever the price is below the realized price, that on average the market is in losses, and vice versa. When the price is above the realized price, on aggregate the market is in gains. So acting against that moving average or against the realized price makes a lot of sense. So you want to be buying whenever we are below the realized price, which doesn't happen that often. It happens maybe every 3 to 4 years. And you want to be selling potentially when we are very high above the realized price. In other words, when people are already a lot in profit and might take the profit. You want to be buying when all people are in losses and they might simply just keep on holding onto their Bitcoin, right? Selling pressure is lower when you are in losses because you simply just wait until the price recovers.
This video is sponsored by the Premium membership. I never take any money from any crypto project. I never take any affiliate links from centralized exchanges. I never pump and dump coins. Instead, I offer valuable tutorials in the Premium membership. Feel free to check it out.
So when you're wondering, should I be following the trend or should I be contrarian and do the exact opposite of what other people are doing? The answer lies in the time horizon. If you simply just hold for a few weeks and you want to simply just take advantage of the massive dynamics in crypto, then you follow trends. But if you're dollar cost averaging into the asset, if you want to ride those macro cycles, then being contrarian makes a ton of sense, especially during the down movements. So I actually made an analysis on correlation here as well for Bitcoin, but also for the stock market. And that correlation analysis was, I checked past performance relative to future performance. So there is a saying, right? There's a saying that past performance doesn't indicate future performance. And that's not only just a disclaimer, right? As in, when an asset went up already in the past, it doesn't necessarily guarantee that it will go up in the future as well, which obviously makes sense. But deriving from this that there's no connection between past performance and future performance is actually wrong. There is a connection. And I made this analysis for 3 different scenarios actually. The first scenario, the first subset of data was I looked at the last, say, 1 year of performance. And I correlated that last year to the next year. And then I did this also for different time horizons. So I did this for 1 year, I did this for 2 years, right? The performance of the last 2 years versus the performance of the next 2 years. So I did that analysis. I did this with different asset classes, with Bitcoin and with stocks. But what I also did is I split up this data set to different cases. So let's say, how strong is the correlation when the past year was negative versus then the future performance? I took then another data set, looked at all the cases where the past year had positive performance, checked how would that correlate to the future performance. And of course, I did the whole mix, right? I checked the entire data set, past performance to future performance. What I found out is the following. I found out that when there was positive past performance, the correlation to the future performance wasn't actually that strong. However, when there was negative past performance, there was an inverse correlation with future performance, especially once you go beyond the 1.5 year time horizon. And that's true for stocks. It's also true for crypto. In other words, when you have seen negative price performance in the last 1 to 1.5 years, you do have an above average expected return in the next 1 to 1.5 years. So being contrarian on that time scale makes sense for any asset class. So because something went up in the past does not necessarily mean that it goes up or down in the future. There's not that much of a connection here. However, if something crashed massively in the past, then it does make sense to go above average into the market. Then your expected return does increase with the future. So yes, there is actually some kind of connection between past performance and future performance. So it's very important to think about time horizons. In the medium term, it makes sense to simply just follow trends and to have a good exit strategy if you do follow trends, because it's a more risky strategy. In the long term, it makes sense to go contrarian, especially if we went down. So it's more important to be buying when we crash than it is to be selling when we went up. Now, there is a third time dimension here. I only talked now about several weeks versus, say, several months and years, right? There's a third dimension, and that is the ultra short term, as in several hours. Does it make sense to follow the current momentum when we're just trading for several hours, say in Bitcoin, or to rather be contrarian? Now, in general, I do not recommend trading on that short of a time frame, because very often you will lose money with this due to transaction fees, due to bid-ask spread, due to front running, due to all kinds of slippage. So in case you do consider to trade on that short of a time frame, right? Maybe make several trades per day, at least several trades per week. If you're considering this, then I would definitely first recommend trying this out. How much do you actually lose when you get in and out? Take a small amount and get in and out of your position 10 times in a row. Simply just to find out how much are you actually losing. So of course there might be fixed costs, right, like gas, etc. That's all can easily be anticipated. But for all these hidden costs, right, like front running, slippage, bid-ask spread, you've got the numbers in theory potentially in front of you, but once you execute, you might still get screwed. So simply just run the numbers for 10 trades with a small amount in and out and see how much you actually lose. Because then you get a realistic expectation of how much you actually have to win with every single trade that you're doing. If you don't have that expectation properly set up, then you've got a problem, right? Because then you're losing in a hidden way. Like it might sometimes go up, sometimes go down, but over the long term, you're declining because you actually don't know how much you are in the end burning. Right? When people say it's zero commission trades, it's zero cost trade, etc., try it out. Right? Try to buy and sell this free zero commission Bitcoin 10 times and see how much you still have left afterwards. Right? Do this, of course, potentially even in a calm market where the price isn't moving so much that you don't get too much fluctuation in your result. So that's number one. But now the question, right? Let's answer the question. If you do decide to do those kinds of trades, should you be following the trends or should you be contrarian? And the answer is normally it only makes sense to make these kind of trades for profit when the volatility is high. Again, because you've got those costs. So you only want to do this when there's a lot of shakeup in the market. You don't necessarily want to trade this on, say, a Monday morning when everybody is asleep. So you want to do this during high volatility times. And then the question is, do you follow the trend? Do you go contrarian to the trend? The answer is you go contrarian. So what you want to do is, again, especially for the purchase, you want to buy when we are crashing. Because what tends to happen is that when we go down in the price, that some people might get forced liquidated in that down movement. So there's leverage in the market, right? Some people don't just buy spot, they buy with all kinds of instruments via leverage. And when the position goes against them, then they have to automatically sell their position, pushing the price further down. That's then how we see those flash crashes during COVID, for example, right? Where you suddenly go down in a few hours by 30-40%. This is not because everybody suddenly panics in those few hours. It's because of automatic selling. So what you can do, and I also made that backtest. There's another reference to this in the premium membership. So all these backtests are with Excel sheets in the premium membership. You can download them. You can see my videos on how I do those backtests, etc. But what I did is I backtested the hourly relative strength index, the hourly RSI. So I took the hourly data of Bitcoin or various altcoins actually, and I figured out when the RSI is at certain thresholds below or above, how is then the price developing in the subsequent hours. And what I figured out is when the RSI tends to be very low, as in at a value of 15, so the RSI goes from 0 to 100, when the RSI is at around 15, so we really crashed very, very fast, then we tend to be outperforming the general price movements in the next upcoming 24 hours. So if we see a sudden crash and the RSI is low in any asset, can be idiosyncratic, then on average it makes sense to buy those dips and to hold for roughly 24 hours. So you want to be contrarian on the ultra short term, you want to be following trends on the medium term, and on the long term, you want to be contrarian yet again. So this is not super intuitive. Nothing of this is super intuitive, but it does make sense once you think about this. And once you run the numbers, once you do the backtests around this, it also confirms these theories. So I do have separate videos on all of the things that I've just discussed on this channel. Normally I discuss this in a more lighter version here on YouTube because it is somewhat of a complex topic. If you want to dive into the details of how to actually run the backtests, right, how to potentially do a backtest by yourself, if you want to get the Excel macro sheets on running all of these kind of things, running different moving average durations, running RSI backtests, running correlations. If you want to get all of this, that's of course in premium. So feel free to check that out. The simplified version, simply just to get the gist of it, simply just to get the takeaways from it, that's here on YouTube. So feel free to subscribe as well. I publish videos regularly. Looking very much forward to having you here as a subscriber. Feel free to also join our Telegram. There is a free Telegram channel. The link is down below. Feel free to check that out. Looking forward to chatting with you. We'll see you over there and see you in the next video. Cheers.